This is Smart Investing with Mike Wren.
Securities and advisory service offered through KMS Financial Services.
This is Smart Investing with Michael J. Wren. With Michael's producer, Chris Martin. You can email us your questions. Go to smartinvestingshow.com to see how.
For I have the pride, the privilege, nay, the pleasure of introducing to you the one, the only.
This is Smart Investing with Mike Wren.
Well, hello again, everybody. You have booted up another edition of the Smart Investing Show. This is the podcast where we try to take the topic of investing. Number one, we try to make it easier to understand. Number two, we try to get you good, relevant information on each and every show. And thirdly, we try to be entertaining, and with the entertaining portion, usually that's Mr. Chris Martin across the kitchen table from me instead of the studio, you know. Good morning.
Studio kitchen.
Yeah, a studio kitchen. So, we were just talking before this podcast that when we were live on the radio for more than a decade, there were many, many different times on how we started the show. Sometimes our card key at the studio all of a sudden wouldn't work, and we were wondering if it was a hint that we were fired or not allowed on the air.
Easiest way to do it.
And it's like we're looking at our watches. Well, pretty soon the station's going to go dark and somebody may realize. So sometimes we'd be beating on the door. Of course, we're such a low-quality, tongue-in-cheek show that they never once gave us two card keys so we each could get in. So we were always, I don't know, like two fraternity brothers that were stupid enough that only had one key to the frat house. So we would always have to be saying, now, do you have the key or do I have the key? And, of course, there was one or two times that Chris would show up, I don't have the key.
Great.
And, we got through it all. Yeah, we got through it all. There was the time that you had the battery stolen out of your car.
Oh, we weren't even going to talk about how angry I was that day. I was in there. I was in that building for an hour, and I came out.
Well, I solved it. But see, the thing is I'd never listened to that message like I said to you. I just happened to see that you called. I called you back. We went. We got a battery. We got it all done. And 2 or 3 days later, I heard Chris's message that he left on the phone, and I think it was even funnier because I could listen to it with the freedom knowing that the problem had been solved. So it's like seeing somebody after they fall in the pile of slush, after they've become warm, and,
You are not the only one who's kept a voicemail of me, though. My wife has kept a voicemail because she was gone and our dog went into labor. And apparently you can, I don't remember, I blacked out, but apparently you can hear over the voice thing, Jenny, there's feet coming out. There's feet coming out. So, then I hung up.
Does she know more about birthing dogs than you?
Oh, yeah.
Oh, okay.
Oh, way more. Do you know more about investing than I do? That's going to be about the level also. Because one time I had to deliver babies, and I had a speakerphone, and it looked like a doctor's ER. I had everything I could have. I just basically took the junk drawer off the hinges and brought it downstairs with me. And
sometimes we really were quite like a MASH episode, weren't we? With Klinger and with Radar, and
yes,
just needed a Houlihan. We never had that. Yeah.
You guys had a Houlihan. It was your very first producer. When I say hippie chick, I mean that in every sense of the word. Your first producer that took me into the studio wasn't wearing shoes. Was white with dreadlocks and just reeked like she'd been in the mountains.
Yeah, she must have moved to Portland.
I'm thinking that was why I got the job.
Yeah,
I showed up in shoes.
We could do a show just about doing the show. We really could. But today, I'll kick it back off to the investment side of things so you can actually get some content from this podcast instead of non-content. But I believe if you are thinking the same way that Chris and I are, the non-content might be what separates this show, what makes it more realistic, what makes it more listenable, and where it reminds you that we're basically human beings and we take it seriously enough to make fun of ourselves. I was just telling Chris that when it started here, I said, Chris, one of these days when there's this big yearly brouhaha that happens, it's a big gathering of all the other investment nerds that happen to use the same mothership that I use, and it takes place in Seattle. I said, Chris, one of these times I want you to go there with me because it's going to give you some good insight. And what I mean by insight is that Chris's big gatherings are called Comic Cons, and they involve people dressing up sometimes in costume, but they actually have an agenda of having fun, an agenda of looking at the movies that they like,
meeting other people,
and then they might talk about what the new movie's coming out or the new episodes.
Anything pop culture.
Yeah, anything pop culture. And so they have fun at it. They have contests. So just imagine a Comic Con with way different, way more boring costumes called suits and ties and things like that, sometimes very poorly worn, and no fun. Just take out the fun.
I feel like if I showed up, I would be like the guy wearing the T-shirt to the tuxedo store.
Yeah. Well, the fun is there are times to where there will be a cocktail gathering, and those are always fun because I try to talk to the people in the back office of this mothership that I work with all of the time, and they're wonderful. The other people that do what I do, I could care less because most of them deal in the package product world, which I can deal with, but most of them by far deal with mutual funds and annuities. And I would rather go in for a colonoscopy than talk about that stuff, to be frank.
Those guys, you don't really need a personality, do you? I mean, if you're just selling a packaged product, you don't need one. You just
Jesus!
You just
That's
mark the
awesome.
check marks.
See,
and then you're on your way.
You're
right?
the listener, all 9 of you. Do you see how golden this is? Do you see out of the mouths of babes comes complete wisdom? Yeah. So imagine how lucky you are if you're listening to this podcast and you're dealing with me. I have a personality. I should be able to charge more for that because the whole industry offers non-personality dealings.
Really should be able to.
So anyway, I digress. That big brouhaha is coming up here in September. There might be a delay in a podcast or two, depending on, how much I use it as an excuse not to work. So anyway, that was it. That doesn't tell you, the investor, anything. What does tell you something?
While we're on the subject of not having fun, not knowing how to do anything. If you liked the Smart Investing Facebook page a while back, I have put a link on that to a newer Facebook page. When I first did the Smart Investing Facebook page, I knew nothing about Facebook, and I blundered my way through it, and it was awful. So if you go to smartinvestingshow.com, or if you're on Facebook and you liked the previous one, I put a link to the new one that I can keep better track of, better stats on. I can.
When do we get rid of the old one then?
The old one. Well, I'm going to wait a while. It's
Spokane.
And it's just sitting there. So if you go to like it, and then every time that I post a new podcast, you'll be able to see that in the feed that another podcast has popped up. So that's if you don't have like iTunes or a phone that you can download podcasts to. If you just listen on the air or on the internet, go to smartinvestingshow.com, click on the Facebook thing, like that page, and then every time something new comes up, you'll be able to know.
Okay, and we're not asking for a like as in terms of we have to be careful.
It's not making us more popular.
Yeah.
For the regulators, this is so people can be updated, so they can like it more and hear it more.
Yeah, exactly. And so it's just a function of working and keeping track. It's not a function of anything else. So, with that, this type of market environment, people are trying to find their way. This type of a market environment is kind of a tale of two cities. You can put a spin on virtually every news item out there when it comes to the investment and the finance world. And also, every one of those topics is so kind of benign that there's almost no spin to put to it at all. And what I find is that if you are a salesperson in our industry, or if you're an economist, or if you're a journalist, there's all kinds of crap to talk about. But if you're actually looking at companies and looking at the earnings, there's a lot to talk about, but there's not a lot to talk about every single week. And there's, frankly, to be honest with you, there's a lot of stuff that I would never share with you on a podcast because I don't want anybody else to get the information for free. There's a lot of reading and research and talking with companies that I do that I don't want people to know that stuff. I don't want it to be public knowledge, contrary to most of the people in my industry that think that they can tell the future and are willing to just blab it to everybody in the world. Well, you kind of get the fact that, it's probably not that accurate. It's probably not that valuable if they're not
giving away for free.
Yeah, right. If they're just, I know what's going to happen, this and this and that. If you know what's going to happen, you're not going to tell anybody. It's like Biff on Back to the Future, right? Wasn't that the character's name that had the sports almanac?
Oh, yeah.
Of the future. He tried to keep that secret in a safe, right?
Right.
Yeah. That's what you do. It's pretty sad to say that this movie Back to the Future is more realistic than how a lot of people in my industry behave.
Well, it's going back to the Comic-Con, is they always have these limited edition comic that you can get one if you go into the building. Well, you can put limited edition all over it, but if everybody gets one, it ain't worth crap.
If there's 50,000.
Right, it's not worth crap.
I believe that there were some Chevys and Chryslers in the 80s that had that on there, limited edition.
Yeah.
Like the Farrah Fawcett limited edition.
We had a limited edition. You know how easy it is to find parts for it?
Travolta Fever down the side, a big decal.
Limited edition meant we have to find that part in China. That's what that meant.
So anyway, what am I alluding to? Well, there's a lot of talk in the markets, and I just took a whole bunch of notes. I'm going to go down from these notes, and we're going to use them as discussion purposes. First thing is that on the internet somewhere, there was Jim Rogers, and Jim Rogers is always, just look him up. Jim Rogers, just like Mr. Rogers, but it's Jim. And
related to Roy Rogers?
I don't think so, but look him up on the internet. Famous investor. There was some article out there. You got to understand that I have these notebooks that are 9 3/4 by 7 inches, where I write down things that occur to me during the day of me doing actual investment management, and then I use it for the show.
Dear Diary.
Yeah.
Today I learned about Jim Rogers.
No, I only write Dear Diary when it's regarding you. Yeah, Dear Diary, never ask Chris
your
that
book
question.
Has a unicorn on the cover, by the way.
No, it doesn't.
Unicorn and rainbows.
Oh, yeah.
Mike's Diary, do not look into.
And it has the little Princess Diary.
It has the tiny
musical.
Little key that you hang around your neck.
Yeah, exactly. You've painted a really good picture for all the investors out there. So the first thing that I have written down is Jim Rogers says that the next bear market will be the worst of his life. Okay? I can't remember if that was in Barron's or Yahoo Finance Online or if it was in Wall Street Journal, but I remember that was one of the catchy things that somebody out there in my in the journalists that cover my industry, they decided to say. Jim Rogers, self-appointed savior of knowing the future, says that the next bear market will be the worst of his life. And my thought was, so I guess he can tell the future all of a sudden. We'll all go to hell. I mean, now there's no reason to actually listen to anybody else except Jim Rogers, because apparently his crystal ball is all paid up, juiced up, waxed, and crystal clear. So that's patently unknowable. Why would you say something like that? You could say he expects it to be, or it might be, no, but it just will be the worst of his life. Well, how old are you, Jim?
That's my first question.
Yeah, so
is
he's
he like
pretty
105?
Yeah, so so there was that. And that brings me down to the note written at the bottom of the page here. Most economists that people look at in my industry and listen to, they're either optimistic or pessimistic. If you're online now and you're reading some economist and they have a positive bent or a negative bent, what's nice about the internet is you could search their name and probably find out some editorials or some articles that they've written in the past. Take a look at them. Do they tend to be always pessimistic? There you go. Do they tend to be always optimistic? saying that pretty soon we're going to have flying cars. There you go too. I mean, it's these economists, they're not God's greatest gift to huge personality titans. They're not going to be an actor that can change their spots depending on the role. They're nerds. They are what they are. So they tend to be, and really, really good economists that are kind of real with themselves. One name would be Ed Yardeni out there. They're actually okay with saying that, they will actually admit up front, I had a pretty good childhood. I'm kind of an optimist, that it helps to know some of these economists' psychology. It's instructive because guess what? They're humans, and Wall Street is populated by humans, and people that invest are humans, and people that get scared are humans, and people that get greedy are humans. The human factor is extremely important. I've been saying that my whole career and just beating it to death on the radio. There's a whole bunch of folks out there that are still following something that's called modern portfolio theory, where they feel that all of the knowledge, since it's a publicly traded market, all of the knowledge on any individually traded company out there is already known. So if it's already known, you can't make any decisions that will outperform the market. Well, that's news to Warren Buffett, That's news to Sir John Templeton. It's almost like the joke that you have two economists walking down the street. One of them is a modern portfolio theorist, and the other one is a behavioralist, which would be more like Chris and I, because we realize that people are irrational. No. So they're walking down the street, and one of them sees a $50 bill to pick it up, and the behavioralist bends over to pick it up, and the modern portfolio theory economist says, don't even bother to pick it up, because if it's truly a $50 bill, somebody would have already seen it by now and picked it up, so we know by it still being on the ground that it's fake. That's truly. Okay.
Because my thought is, if it's fake, then I'm going to go have fun and throw it down on the ground and watch other people pick it up.
Well, do you know, that's really what they say. They say, don't bother. The colleges, the universities, well-respected, are still graduating students telling them, don't bother to try to make better decisions than the next person. It can't be done. So just do this and this and this.
This reminds me of like when you go to an interview, don't bother. This guy's already got it. Do you just turn around and, oh, okay, and then you just leave?
That's what a lot of my competitors are doing. When I have competitors that tell people to own 10, 8, 15 different mutual funds, or in this day and age, it's 10 or 8 or 15 different ETFs or exchange-traded funds that, quote-unquote, make up your portfolio. Basically, they're picking up all the crap up off the floor, throwing it at the wall, and seeing what sticks. They have no basis in reality. They're not doing a damn thing for anybody. And guess what? You get to pay for that. That's where the awesomeness comes in. You get to pay them for not having a personality and not working or doing anything for you. Awesome. God.
I guess maybe not having a personality, there's no highs or lows, so you think that they're taking it seriously. They have this I don't know, this aura of, well, I'm taking it seriously. That's why I'm doing it this way.
Well, you know what they never do either? They never look at themselves with any self-doubt that we can tell.
Yeah.
I do that all the time. You, the client, depend on me. I know that. You, the client, trust me. I know that as well. We both know that I can't tell the future, so we have to be really, really careful. I know that I have some biases. We all have biases, like the confirmation bias, where we like to listen to podcasts and go to things that we're familiar with or things that we already, quote unquote, like. Well, when you're talking in terms of investments and companies, what if there's investments or companies that I don't like, but yet would be profitable for you, the client, to own? Well, that's a little bit of a conundrum, isn't it? If I don't like it, why wouldn't I not like it if it's going to make you, the client, money? There would be no reason on earth that I wouldn't like it, but it would be some sort of a bias, a personality, psychological type of a bias that I would have towards something that would affect the client's performance badly. Or on the other side of the coin, I would like something that doesn't make my client any money. If it doesn't make him any money, why am I liking it? Just the fact that I have questions like that, and I ask myself those questions and go through a debate and my office partner talking about it with him, just the fact that we do that raises us up another level in our investment society, because near as I can tell, damn near nobody in our investment industry is willing to talk openly about our own weaknesses or biases, because they are so big that if they go down that slippery slope, they're going to realize that at the bottom of the slope that they're not worth the money that they're charging the clients. So it's really better if you don't go down that slope. Kind of like asking yourself if you're a good father or a bad father. Well, there's certain people out there that might be kind of a scary thing, so you just don't ask, because you're afraid that at the end answer might not be all that good. What are you laughing about?
How good's the food here? It's great. Well, what's the chef like? The food is great. Don't ask about the chef. Yes. He sits in there, he makes it in the nude, he never washes his hands, but the food is great. Okay.
Well, you know what I mean, though. It's my partner, his name is Chris in the office. He came to me the other day and he was saying, I'm thinking about this and that, and there's all these other companies. And I said, just the fact that you're questioning yourself, that's what you should concentrate on. That's the good behavior. It's be kind of somebody that's trying to lose weight. Don't congratulate the person that's losing weight so much on when the fact that they drop a pound or two on their way to dropping whatever their goal is. Because when that pound or two comes off is kind of unknowable. It's kind of a happenstance or a random occurrence, and it's just not knowable. So you are going to be rewarding something that isn't repeatable. So you should reward the repeatable behavior, which is eating less that's on the plate or eating more healthy. I didn't eat the whole plate of fries today. That's a rewardable behavior. Reward the behavior that can be repeated every time. And that's what I try to do with myself. That's what I try to do when viewing portfolios, is that self-questioning is extremely important in the investment industry. Yet you don't have anybody talking about that because they're too busy telling you that they are God's gift to investing and that they can tell the future, like Jim Rogers, him saying that the next bear market will be the worst of his life. Good for you, Jim. I didn't know that you could tell the future.
But and could that mean just for him? Could that mean for his clients? Could that
how
mean
would you
everyone?
know? Yeah,
is he 20?
But you know that Yahoo Finance or whoever puts it up there to try to get people to click on it.
Right.
Clickbait.
Right.
I think is what you call it. Yeah. So something else that's happening in the out there is that you'll get people in my industry, and you'll get journalists that say, as interest rates go up, it's going to beat up stocks out there because people that were not getting any money at the bank, any interest at the bank, well, they bought these certain group of stocks that pay really good dividends. But as the bank interest grows and you can get more interest on a government treasury bond or a CD, that's going to take money away from those companies. I guess if the people that own them are complete imbeciles and idiots, yeah, you're right then. But they're not. They're under the assumption that rising interest rates are bad. And they're under the assumption, they're trying to project the assumption, they're just talking about crap they don't even know. They don't even explore it. They're saying that, you own a company like a Procter & Gamble or like a Coke that's got a good, consistent dividend. As interest rates go up, that's going to beat up that company typically. No, the hell it's not. What are you talking about? Okay, the more the company raises its dividend, the less its stock behaves like a bond. And the reverse is true as well. If you owned a company like a Vista here in Spokane, and WWP before that, people have asked me, to invest in that. I've never told them to invest in it at all because I thought it was a crappily run company and they barely made enough money to cover the dividend, and the dividend increases were very, very few and far between. That type of a company does behave like a bond, where the income that you're getting from the investment is fixed. So Bonds out there, for all of you investors, they're called fixed investment instruments. In other words, the interest that you're getting from the bond is fixed. It never gets increased to you. There you go. That's why interest rate movements affect bonds so much. But if you own a company that gives you a yearly dividend increase, something that the bond industry never gives you, well then that company is not going to behave very much like a bond because it's not a bond. And the interest that they're giving you, if they've got a history of dividend increases, well, that company is going to behave a lot less than like the bond industry. And the companies that people always are willing to tout that say, oh, these companies are going to be affected by interest rates, every single one of them, to the best of my memory, has been companies that raise their dividends that won't behave like the bond market. So the people talking about all this wonderful strategy and logic, they're full of crap. They don't know anything, or at least they don't know anything about that subject. Maybe they know a lot about golf or tiddlywinks or changing a tire. I don't know, but it sure as hell isn't investing. So there's that. We also have a lot of people out there, my industry, blah, blah, blah. One of the nice topics is, oh crap. I almost said a bad word. Oh, crap. The market.
Okay, you've probably said it before.
Yeah. The market, we've gone up so much, we're bound to have a down market. Well, let me ask you this. Which hurts more, falling off a roof or falling off a chair?
I have done both. And
okay,
the roof hurts more.
There we go. So it's a higher point. Busts are usually created by booms, like a boom and bust cycle. Okay? If we're going to have a bust, I'm okay. I'm willing to buy in on that. Just tell me where the boom is. If you're so worried about a bust coming, okay, we're going to have a market crash. Granted, okay, I'll believe you. Where is all the speculation in the boom at that's going to create this high point to fall? Because so far right now, we're at the chair level. We're not up on the roof. That's just my feeling. When we've got forward-looking earnings and so on, yeah. So tell me where the big boom is, and you've got me. If you can sell me on where the big boom of speculation and in crazy, crazy valuations that don't make any sense, like when you had people getting ninja loans for their house, no income, no job, no assets, but they can get a loan, and they were buying 2 or 3 of the suckers, that's a boom. That's speculation. Where is that type of behavior happening now? If you can tell me, I'll listen. As far as I can see, and I'm not the smartest person on earth, okay? But far from that. There might be some industry where there's a lot of speculation going on like that I'm unfamiliar with, but I'm here to tell you on this podcast, I'm unfamiliar with it. So I'm not seeing a huge boom anywhere, so I'm not seeing a huge bust. Now people do get nervous when Trump opens his mouth for trade, for example. Maybe he doesn't go about it in a very logical manner, but he is going after fair trade, not free trade, okay? It's kind of a messy situation, and if anybody can make it more messy, it's probably Donald Trump. But the fact of the matter is that it's my thesis that he is not the devil, and he's not trying to make the world, disappear or make our United States economy disappear. The Chinese and the Chinese economy are very well guilty of a lot of intellectual property theft and not being respectful of many other Western economies in the way that they operate. And he, Mr. Trump, is going after that probably in kind of a very, very, fraternity boy way, calling him out, so to speak. It probably could be done in a more tactful way, but it really kind of doesn't matter what way it's done as long as there's progress to be made. So if in the end that there's progress where trade happens to be more fair, any short of short-term up and down in the market, I'm just not afraid of it. I'm not worried about it. That's my own personal opinion, and I think it's a little bit more reasonable and based in reality than either me being a huge, huge Democrat and telling you one thing, or being a huge, huge Republican or telling you another, or being a huge, huge optimist or pessimist and taking one of those veins. I'm kind of right in the middle,
Or being a huge, huge Jim Rogers.
Yeah. Yeah. So anyway, back to rising interest rates. Another note that I have written down here, rising interest rates don't mean that the market is going down soon. Booms create busts. Where is the boom? Where is the speculative boom? Okay, I covered that. Rising. People think that as interest rates are rising, that's going to be a cause for the market to go down. No. They just remember interest rates rising because typically when you have a market and you have an economy that's getting hotter and hotter and hotter, the Federal Reserve will see that and they will start to raise interest rates to make interest rates, higher to try to maybe slow the economy down a bit to try to keep inflation at bay. And that's, I guess, typically a good thing. It's worked in the past. I don't know of another economy better than ours. So it's worked in the past. Frankly, they have to raise rates as well, so they're at a point that when we go through the next downturn, they can lower the rates again to get things kind of help, like give it a little bit of a shove. It's kind of hard to lower them and give the economy a shove if you're already at zero. So they've had to raise them. And the economy is doing better, and there's little bits of inflation here and there, so they're going to be raising them further. That's not a death blow to the market. That's not necessarily a negative event. It just is what typically happens in the cyclical type of an economy. And what people, though, usually remember, they usually remember when the economy gets really, really heated and maybe the Federal Reserve is really trying to keep a lid on interest rates where they raise the interest rates quite a bit over a year or two. That caused kind of a negative relationship in the markets, the bond market and the stock market, and they have their desired effect of slowing those markets and slowing the economy. And people, that will happen in the end. That pretty much has happened most of the time in the past, that the Federal Reserve, as they raise rates, tends to slow the market down at some point. But it doesn't happen from square one. From square one, it's just the normal cyclical of things getting busier, and so the Fed trying to raise rates to a normal level from what has been a below normal level for a very, very, very long time. So with that, I'm going to gather a few more notes here and all that. We'll take a very quick break. You're listening to The Smart Investing Show with Mike Wren, your host. Chris Martin, the producer. We'll be right back.
This is Smart Investing with Michael J. Wren.
How about you're welcome? How about I'm so happy to be here for you all so I can take the blame?
Any opinions expressed herein are given in good faith and are subject to change without notice and are correct only on the stated date of issue. Past performance is not always indicative of future results. This material is not intended as an offer or solicitation for the purchase or sale of any security or other financial instrument. Security, financial instruments, or strategies mentioned may not be suitable for all investors. Prices, values, or income from any investment mentioned in this report may fall against the interest of the investor, and the investor may get back less than the amount invested. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as a recommendation of particular securities, financial instruments, or strategies to you. Before acting on any recommendation on this material, you should consider whether it is suitable for your particular circumstances, and if necessary, seek professional advice.
You're listening to Michael Wren.
Maybe we should chug on over to Mamby-Pamby land where maybe we can find some self-confidence for you, you jackwagon.
Okay, we're back. Thanks for that break there. So talking about just the general, I guess it's the general discussion points that I hear time and time again, whether it's the internet, the television, the radio, about the investment world, they're all falling into the categories that we have talked about so far. The final one that I have taken notes on is market valuations. And these are typically this sort of a comment or an editorial that you'll find in some media. They will say that the market has been up for 10 years and we're down to have a market, we're determined to have a market correction sooner rather than later. Okay, I can agree with that, but, a market correction, to me, in a very short amount of time, all of a sudden, the analogy would be we're spending an awful lot of time predicting when we're going to catch that cold, when we don't even need to go to the doctor when we catch the cold, that it's going to be temporary, or even the flu. It's not that fun, but unless we've got some weird complications, it's not going to kill us. And a market decline isn't going to kill you unless you've got some weird complications like being stupid and having all your money in one, company only one company itself, or, if you're just not being a reasonable investor, there might be some extenuating circumstances to where market decline might be, Armageddon for you. But I think that that's an extremely rare occurrence, frankly, and not just the people that work with me. I mean, people that work in general. If one thing my industry does is they over diversify people, which means that, it makes the market declines and recessions even more benign for that person's account than they usually are, I guess. So, in a very short amount of time, spending a lot of print or air or internet time on the next market decline and talking about that they think that market valuations are so high and, oh my God, it's horrible. Well, it's not that high. It's not that horrible. And like I said, you're spending an awful lot of time about an event that occurs with regularity that doesn't kill you and is temporary in nature. So why spend so much time about it? Well, because it's emotional. And like I've said before on this show, some people are wired to where this fight or flight response, where you have the sympathetic nerve system and the pathetic nerves.
Okay.
No, I forget what my brain isn't working. I forget. You've got two nervous systems. One kind of excites you and builds you up, and one mellows you out and makes you content. And what happens is when people when they start to get anxious and anxiety, that overcharges that nerve system that makes you more anxious and have more anxiety. That's not a good situation for you behaving reasonably and not panicking. It makes you more panicky. And anybody that's panicky isn't going to be a good investor because you're behaving like it's a life or death event, and it's very much not a life or death event. But your body is telling you that it is, and you're trying to figure out why, and then all of a sudden, well, hell, maybe it is a life or death event, and people...
Well, isn't that a caveman survival thing?
Totally.
Like, if you expect the worst, then maybe we'll live through it.
Yeah, exactly. So getting back to market valuations, in my opinion, they're reasonable. And to me, I'd rather have them below reasonable. I'd rather me be getting a deal, and not just a deal, I mean a damn good deal on everything that I'm investing in. I'm not. I'm only getting a fair deal on most of the times. There's some good deals out there, but most of them are fair and reasonable. Depending on if you're pessimistic or optimistic, there's people that are going to say, well, that's a bad thing. They tend to talk about, you hear now that the market's never been this high, and it's only been this high right before the last corrections, okay? You need to take a step back and figure out who's giving you this information. There's one group of economists and market prognosticators that typically look at trailing numbers, trailing earnings, okay? Those people, one of them name is Robert Shiller, and he was famous because he was one of the few people that said, hey, I think there's a lot of people buying houses that probably shouldn't. Okay, he found that. Great. Does it make him the world's greatest market predictor? Hell no. It just makes that one event. But if you're Yahoo or if you're MSNBC, if you can get Robert Shiller on the air, you're going to get some eyeballs. You're going to get some clicks on internet time. You're going to be on that like stink on a monkey. When has Robert Shiller ever been overly rosy and optimistic about anything? That would be never, that I have heard. I'm sure maybe if it's something not about investing, that he'd be happy about it. But I don't typically. But
basically, when it comes down to media, though, I mean, if it's one thing that I have seriously learned in the last couple of years is they don't care who it is, as long as people watch. You get your 5 minutes worth of people watching, so you got your advertising budget, and then you get your clicks for your clickbait. They're just pulling in a name, a brand name. That's all it is. Mm-hmm. So it doesn't matter what he says. He could come on and say, sky's going to fall, literally. And, all right, world's flat. Cool. Thanks for having.
Yeah,
thanks for showing up.
They never do that. They pile on.
Right.
Oh, what? Well, why? Oh, really? Well, should I do something? Oh my God. That's that sort of thing.
Will there be blood? We'll be right back after this.
Yeah, so Robert Shiller, those economists and market people, they're looking at the trailing numbers. You have another group of people that tend to be way more realistic and way more optimistic. And right then, the people like Robert Shiller will say, yeah, but they're the people that never see the market coming. Well, nobody sees the market coming. Nobody sees the downturn coming. So
nobody expects the Spanish Inquisition.
Yeah, you didn't see the market downturn coming, Robert. You just said that you thought the housing was getting, weird. You didn't say, oh, the market's going to go down this and it's going to bottom out in March of 2009. So shut up. You called this. Yeah, you get your kudos. Nobody else did. But, it doesn't mean that you're going to predict the next one. You're a lot older and probably a lot more lazy since back then because you've got all this money and people coming to you. Are you questioning yourself and your own beliefs? Probably not. So yeah, you've got the people that look at trailing earnings, that trailing earnings and trailing numbers. And then you have the economists and market people that look at forward earnings and forward numbers. Neither one of them are correct. The one that tends to be the most accurate most of the time are the ones that are looking out the windshield and then they try to put a reasonable spin on whatever the analysts and the companies say that their earnings in the future are going to be. They typically discount that to some degree. In other words, normalize it. So anyway, I hope these few little market events and market thoughts help you on today's podcast. I'm Mike Wren, your host. This is the show Smart Investing. We'll be back again next time with hopefully another good show.
And don't forget, we do have a new Facebook. So just go to smartinvestingshow.com and click on the Facebook icon in case you don't have a podcatcher or anything, so you know when a new podcast is up and when I post something over on YouTube.